Hey trader, Stephen Kwitzel here with the TradersPlan.com. It's Thursday, April the 19th, we have a lot to cover in the market today. Commodities continue to be strong, starting to get a little selling pressure on Thursday. Before we get into that, let's take a look at the disclosures real quick. Alrighty, let's get back into it. So let's start with the Nasdaq because that's really what I'm watching. It is, tech heavy. It's more aggressive stocks than the S&P 500. So you want it to outperform the S&P 500. Doesn't mean it always has to. So right now, really what I'm looking at, you have this 20-day moving average. You had a nice uptrend right here, broke above this resistance, the 20-day moving average at this little pivot point right here, kind of a little mini double bottom, broke above that, came down, tested tried to have a shakeout, tested the 20-day moving average, closed a point below it, but I'd say for the most part it held, and then negated that reversal right there, which was last Friday, completely punched through the 50-day moving average, cleared this bar, cleared the 50-day moving average, and right now it's just pulling back a little bit, so it obviously doesn't go straight up. We're looking for a nice, tradable rally, one that continues. So I'm continue to watch the rising 20-day moving average, the 20-day EMA, now that it's starting to curl up. Typically, if on tradable rallies, as you can see over here, it will find support at the 20-day EMA. Sometimes, you get a little bit more choppy of a rally, but you can see it found support right here, found support right here, broke it right here, but found support at the 50-day moving average. But I'd like to see a nice tradable rally above the 20-day EMA. And we're going to look at past corrections, what it looked like coming out of the corrections, because I believe right now we have to assume we're coming out of the correction based on the price action and what we can potentially expect. So let's look at the S&P 500, look at the daily chart. So it pretty much looks the same. Popped above the 50-day moving average and now it's pulling back, and right now it's sitting on top of the 50-day moving average. But I wouldn't be surprised if it just kind of pulls back under it, finds support right at this. Here, let me draw a little crossbars right here. A little inspect. Wouldn't be surprised if it came back and found support right in this area, right where it cleared this 2672 and where that 20-day moving average meets. So if it breaks back below, it doesn't mean, we're going to just crack wide open. It means the tradable rally just got a lot more complicated, so might not be so tradable. So that's what I'm looking for. I'm looking for that rising 20-day EMA, because most of the times coming out of corrections, especially when you have a nice little second leg down right here, it should hold. It doesn't mean it always does, just means that would be an ideal scenario if the market wants to play nice. So this is the 60-minute chart on the S&P 500, and you can see it had closing support right at the 2560 level. Last week I said I wouldn't be surprised if it comes up and fills this gap, which, boy, it did that to a T, right at that 2710. The S&P 500 filled that gap, came in, and is now pulling back a little bit. But, we're still in a little tradable. I still am going to call this a tradable rally. We'll just kind of wait and see, but if it you might be able to draw a trend line right here, but I'm not going to do that. I'm trying to avoid too much noise, so I try not to go too short term. But just right now we're going to wait and see, and hopefully this will settle down here, even if it pulls down a little bit, and then continue its advance. So right now, just kind of paying attention to more the 20-day EMA, not necessarily the shorter term charts. So looking at the Nasdaq, I think it's important to go back and look at past corrections. So S&P 500. Now we're looking at the 2015 correction in the S&P 500, and I think that this correction mirrored the one we were in, at least from a kind of a double leg down standpoint, more than some other corrections. So I'd like to take a look at it, and we've studied what happens within these corrections over the last couple months. Now it's time to study what happens coming out of the correction the last couple months. So you can see that there's two legs down, right? Sucked everybody in and then stopped everybody out. If we go and look at the chart of the Nasdaq, kind of did that right here. came down, sucked everybody in, and then took another leg down, a little double bottom. So we got that there, check. Now we have a breakout, and we're following the 20-day EMA to see if we can get a nice tradable rally just like we did out of this one. So this is 2015. So it comes out, boom, it tries to slam down. You can see right here, but it came back and found support at the 20-day moving average. This was coming right out of the gates in 2015. So I'm going to call that a shakeout. So let's go back and look at what happened on Friday. And they're not always, don't look exactly alike, but I would say this reversal was probably a shakeout, or tried to be a shakeout. And then it cleared this little mini pivot right here. So if we go back to 2015, you had the shakeout, and then it cleared this little mini pivot right here. So right now, if you look at history, everything is looking right. We're just hoping this 20-day EMA can curl up and we can get a nice, 2-week to 2-month rally. So now what we're expecting is hopefully the rally to hold, and then we get a test at the 52-week highs. So along this rally in the 2015 correction, you had multiple times where it tested, where you could see it, it was strong, pulled back for a few days, tested the 20-day moving average, bounced. Strong, pulled back for a few days, tested the 20-day moving average, bounced. Now, typically, so you have that right here, and we don't know if that's going to happen on this rally. That's what we're hoping is happening. And why I think it could happen is just because we already had a second leg down. We already had a shakeout. Like I'm just hoping that we can get a tradable rally like this. So you have a couple bounces, which is to expect. Now, where you probably want to start locking in some profits, if you haven't already on the uptrend, is once it clears this little pivot right here from the second bounce and takes a new high on the tradable rally, you want to start booking some profits as you break this little mini pivot, right? So it just made its second test, broke to a tradable rally high. Typically the first two tests are successful. Sometimes the third one, but after that the market gets a little tired. So it's a good idea to lock in some profits, not all, because you don't know how far the rally is going to go. Or you could at least sell some of your weakest holdings. So if you had a nice strong rally, and some of the stocks that you bought, hopefully you bought as the rules sucked you in, didn't go up as much, you probably want to sell your weakest ones and hold on to your strongest ones. So you're taking some profits up here. You're trying to stay in on this tradable rally as long as you can, at least for most of your stock. You don't want to sell too short in the rally because, just worried that it'll roll over and crack, because that could happen. It could easily, this rally could fizzle out right here, roll over and crack. But if you don't hang in there as long as you can, you're not going to have any big winners in your portfolio, because all your small winners and your small losers are going to offset each other. You got to have some big winners in there to outperform the market. So you got to try to hang in there, and the trend is your friend until it's not. So you take some profits up here, and then once the Nasdaq or the S&P 500 breaks the 20-day moving average, then you probably should sell most or some of the rest of your short-term positions as it's breaking. Now notice I say short-term because this is a short-term trend. The 20-day moving average is a short-term moving average. So I'm not telling you to go out there and as soon as this happens, go to zero. I'm just saying that if you have some short-term swing trade positions, you're trying to catch an intermediate trend, short to intermediate rally, it's harder to make money as the 20-day moving average breaks and as the market is chopping around, it tends to be trendless. So you take some profits up here, some profits up here. So again, I'm going to recap. You get the breakout, the shakeout, bounce one, bounce two, sell some profits after it clears the second bounce pivot, and then sell some remaining profits, not all, once it breaks the 20-day moving average. Let's look at some other corrections just to kind of show you what's possible. So here in the 2011 correction, this was nasty. This was hard to put up with right here. This is a lot of chop. 1, 2, 3 months worth of chop. But you had your reversal, you had your breakout. Now you're riding the rally. Now this just completely cracked, right? This just got choppy from the get-go and completely cracked. And you can see right here, when it tried to get strong and then rolled over, it broke the 20-day EMA, and then it tried to go higher and got slammed down again. Boy, if you weren't out here, you should be out here, because, you know, or take some profits because somebody's telling you something. And then it rolled back over before it could catch its footing several times. So, you know, the 20-day moving average is not the holy grail, but it's a nice little trend indicator. And then you can see right here, after you had multiple shakeouts, then the rally really got strong finally towards the end coming out of this. And if, let me just kind of add a month or two to this to see what it looked like. Yeah, then look at that. So once you catch your footing, look at how long that rode. You can see it's got stopped out right here. And I probably would have been out, and then it just went back to an old high. So, you know, sometimes whipsaws happen, get back in, right? Even if it whipsaws you out again, because, I mean, it's meant to stop you out. But look at the nice tradable rally coming out of this correction. It gets pretty strong once you get through the chop. Let's go look at the 2010 correction. A lot of chop. You had a correction, sloppiness for, this was from basically from the end of April to September. Market breakout right here. You could have drawn a downtrend line right there and bought that probably on the same day. But I mean, that is a 1, 2, 3, 4 month correction, 4.5 month correction. And then look how strong it is coming out of the gate. So looking at past corrections, this is why you don't want to just get too trigger happy and sell too early. You want to be aggressive as long as the market is trending, okay? You got to catch these rallies, because you honestly, you might only get 2, 3 max of these rallies per year, maybe even 2. Even rallies like this don't come every year. And you want to catch those to make sure that your portfolio outperforms the overall market. So if you learned anything, I hope you just learned, see, it tested right here 1, 2, 3 times. So probably would have been selling something right here, but you don't want to sell all. You want kind of your last, at least for your short-term positions, to be, you know, right as the market is cracking the 20-day moving average. Boom, you have another breakout, tradable rally. So let's go look at some other things. I want to look at the VIX. The VIX is rising today on Thursday. You know, but it got pretty low. Like, it got all the way back down to 15. A VIX sell-off is always a positive thing. You know, if it creeps back up, I mean, it doesn't go straight down, right? It goes down, goes up, goes down. It zigzags everywhere it goes. So if it goes up a few points for a few days, don't freak out. Again, pay attention to the overall trend. Follow the price action. I don't trade off the VIX. These are just secondary indicators. Sometimes it's important to pay attention to, so you can get some of these real spike highs, and that could have been the low. But in looking for, you know, secondary, I wouldn't say secondary entries, you can, let's look right here. So you can look for divergences. So, you know, right here, for example, the VIX spiked on this correction all the way up here, but then on its second leg down, the VIX didn't even get anywhere close. So that would be a positive divergence in my book. So right now, the VIX is creeping a little bit, but we are way, way under 20, and that's a positive thing. Treasury yields, the 10-year yield is popping today. We are right at that inflection point, looking like it wants to break through. I would expect it to break through, which should be long-term positive for financials, because you can see right here that yields are positively correlated with financials for the most part. You can see there are some periods down here where they do decouple and don't. There is either no correlation or a negative or a positive correlation, or a negative correlation, excuse me. But you can see for the most part, financials are positively correlated with the yield. So I would expect long-term financials could do well. Negatively correlated with utilities and REITs. So typically these conservative sectors could not do very well in a rising interest rate environment. So let's look at bonds. So if Treasury yields are rising or looking okay, should have an inverse effect for bond prices. So you can see the TLT, this is a 20-year bond, just a simple bond ETF. You had a downtrend, really a counter trend rally, and even though this looked like it could have legs, really paused right here at this topping formation, rolled back over, and then had another counter trend rally at that 50% retracement and is cracking. So this crack right here and this kind of roll back over, I believe that will continue to support the positive treasury yield. Should be positive for financials in the intermediate to long term. CRB2. Okay. So what is interesting though is the CRB, the commodities index, is really firming up. I thought it was going to crack and I thought the dollar was going to go the other way, but that just goes to show you sometimes you have to wait for the chart to make its move before you get too fancy. So right now you can see the dollar, the purple line, you can see how negatively correlated commodities and the dollar is. Commodities go down, dollar goes up, and vice versa. Well, it's looking like the vice versa. They could cross again where commodities get strong and the dollar gets weak. I'm not going to say this dollar is broken down yet because it's not. It could just be a little bottoming pattern right here and it could take back off. So again, you know, this little pattern has been happening for several months now. So these ships, they take a while to turn, especially if you're talking about a long-term trend. But I do know, whatever the dollar does, I do know the CRB is looking pretty strong. So it's really important to understand that not all of these relationships between commodities, dollar, oil, gold, bonds, treasury yields, not all of them, whether they're negatively or positively correlated, that correlation isn't every day, day by day. So I wouldn't really recommend making trades based on what the correlated asset is doing. I would make trades based on what the asset you want to trade is doing. So like right now, we don't know what the dollar is going to do, but I do know that the CRB is strong, that commodities are strong. So whatever I think of this, doesn't matter. Commodities are strong. Buy commodities or focus on commodities. Focus on the trend. Don't always focus on the relationship. Keep in mind that the relationship is there to provide insight. But again, you want to trade the trend, not necessarily the correlations of what it's connected to. If that makes sense. So we have a nice little uptrend in CRB. This is a weekly chart, but it's looking right. Oil's looking right. Miners are looking right. We're going to look at more of them in a minute. Let's go look take a deeper peek in the dollar. So you have the USD right here on the weekly chart. Nice downtrend. It hasn't cracked down yet. You know, and I'm not going to say it cracks until this 89 level breaks. And today it's turning up. It's a weekly chart, so it's not showing. So right now, if the dollar turns up, you would think that if it is going to turn up, you would think that that would allow small caps to lead the S&P 500, the S&P 500 to lead international stocks, and the S&P 500 to lead emerging markets. And you can see right here, and this is a relative chart, so you can see right here when the dollar gets weak, it means S&P 500 underperforms emerging markets. This trend line just got broke. It's not a decisive break, but it is breaking. That means this downtrend since the beginning, the end of 2016, where emerging markets have been outperforming the S&P 500, just got broke, okay? So to me, that's telling me that the dollar is supposed to go up. You know, same thing with the S&P 500 versus the all-world index. You can see how they all top together. The dollar tops the relationship versus emerging markets, international, and small caps. So international stocks tried to break out, it failed, but it's coming back. So we'll see if that trend line gets broke. If emerging markets continue to, S&P continues to break out relative to emerging markets, I would expect the international stocks to follow. And we can already see what small caps are doing relative to the dollar. So if the dollar is strong, typically means small caps are going to outperform the S&P 500. That has already broke. It broke right here with the international stocks. So these relationships, it's funny because the CRB is telling me that the dollar should crack. These relationships are telling me that the dollar should go higher. Whatever should happen, I don't know. But my point is, trade what you see, not what you should expect to happen. Okay, trade the trends, trade the rallies. If commodities are getting stronger, trade commodities. Don't wait for the dollar to make this massive move because it could go sideways for 2 years. Trade the relationships that you see. So right now, it really is looking like the S&P 500 could retake the leadership among international stocks and emerging market stocks based on this breakout of a downtrend line since November of 2016. So let's go look at some market breadth. S&P 500 breadth. This is positive. So this is the percentage of stocks above the 200-day moving average. And this is one of the really only breadth ones I watch. It's a little bit lagging, but I don't really like too many signals. And again, I'm just trying to get a broad indication of, do we have broad participation in the market? In that we do. You can see it's above 60%, which is a bullish signal. So it means 66% of the S&P 500 stocks are above their long-term moving average. That's positive right there. We're getting out of this correction. So could it come back down? Absolutely. But this is a secondary indicator. So we're just looking at the evidence to see, okay, that's why I continue to think that the 20-day moving average could hold. Doesn't mean it has to. This is the 50-day, but if it holds, then I would think this would get stronger. And this is the percent of stocks in the S&P 500 above the 50-day, 62%, above the 20-day, 77%. So definitely in the short term, it's in rally mode. But again, you can see how much whipsaws there are in this. That's why I like kind of a more longer term indicator, just to show me the longer term trend, because I can look at other things to see what's moving in the short term. So let's go look at the sector summary. You can see the market's kind of coming back today. Nasdaq has been weak, but again, it doesn't go up every day, so I'm just waiting to see what the moving averages do. Looky here, you can see that the Russell 2000 is the strongest indice versus the Nasdaq and the S&P 500. Not quite as good as the Dow Jones, but I don't think the Dow Jones is a good representation of the market because it's only 30 stocks. So let's go look at the sector summary to see what's strong. Okay, so financials are leading today. It's not surprising because yields are up. Consumer staples are getting hammered. This is mainly because tobacco stocks are getting hammered today. So you can see tobacco's down here. It's dragging the index. So, I've said this several times, and that's just to go to show you, sometimes what you call your concern, look at the scooter ranking, 1.3. This is the weakest sector by far. What you think is a safer sector, I mean, it can be out of favor for a significant period of time when, to me, being in the safest one is being in the strongest one, or the strongest 2 or 3. So if we go let's look at what's the strongest in the last 1 month. Energy. It's not even close. Energy is up with the strongest scooter ranking. It has not had the strongest scooter ranking in a while, so that should show you that you need to focus a little bit of your portfolio on some energy stocks. Materials and utilities. So commodities are towards the top in the last 1 month. Let's look in the last 1 week. Energy, utilities are up there. I don't really like seeing that, but it's just week by week, doesn't matter. But for the most part, energy is up there, commodities is up there. So if we look within the energy sector in the last week, coal is strong, renewable resources is strong. Let's look in the last 1 month. Pipelines are the weakest. Coal and exploration, that's your XES ETF. There continues to be broad participation in this industry. Look at all that green on the screen. There is some buying off of the bottom. Not all stocks are moving up, but I would say for the most part, that is really broad participation within this exploration and production ETF, XOP, XES. So let's go look at some individual ETFs. Okay, we'll look at energy first, and then we'll look at gold. So let's look at the metals and miners. Man, that looks pretty bullish to me. XME, the Spider Metal and Mining ETF, you can see relative to the S&P 500, broke out of this downtrend line, heading higher, had a double bottom. Man, that's pretty aggressive for an ETF, but look, it's popping again. So you can see that if you can get on the right side of this trend, man, it's not a bad place to be. If you catch a nice trend, you might want to sell some into strength, but then you could just play the 20-day moving average, and I mean, really any of them. You sell into some strength, sell right here because you don't know how long the trend is going to last. Could be this, could be this. You just don't know. That's why you got to keep some money in play. Might not be a bad play, but metals and miners are looking positive. XES, you have West Texas Intermediate. Oil up here, breaking out, clear as day, headed to 52-week highs. This XES ETF right here, it's really been trendless. It's kind of just been, it almost looks like a head and shoulders, but look at all this volume down here. So I think this rally will hold, although don't be surprised if this retraces a little bit. This is a pretty steep climb out of here. Lots of volume, so it's positive that could have some more legs, but don't be surprised if it pulls back, retraces a little bit. I would look at that more as an opportunity to hop on board. I don't know if I'd hop on board here just based on the steepness of this, because it has gone from 14 to 17. I mean, that's at least, that's 20 to 25% right there. So look for the retracement, but oil is breaking out. Again, could go back to 100. We just don't know. So let's look at the XOP real quick, and then we'll move over to gold. You know, looks pretty similar, although it looks like it was a little bit stronger in the bounce back. It sold off just as bad as XES, but it didn't go back down the second leg as bad. So a little less volatile, but look, lots of volume coming in here. That's not you and me. We're not moving the market. It's not your grandma up the street. It's a pretty nice uptrend right here. Look for a retracement. A little bit extended right now, but I think energy you want to really pay attention to, because it's got some of the strongest scooter rankings, and there's broad participation and breadth that is coming into this industry. Let's look at some gold, then we'll look at some gold miners, because this is interesting. The price of gold contracts right here. 1353, right at this 1357. So, you know, it last week, I believe, it was at 1360, so it's breaking out above this slightly, but I still say that it looks like it's trying to break through this. You know, gold from 2000 all the way down from 250 to 1826. I mean, that's a 6.5-fold move, 7-fold move, so it's a big one. So which isn't surprising if you have a big move over 11 years, that then all of a sudden you take a pause. So it's been a breather since mid-2011, which, I mean, that's 8 years right there. And now maybe the uptrend resumes and we get another leg like this. I don't know. But after you get just major advances for a decade, it's not shocking to see it just take a pause for a decade, right? Everything stair-steps its way higher. Whether it's a stock or a bond, or even if you're looking at long-term charts. This is a monthly chart right here. Let's go look at gold miners. Okay, so the price of GLD up here. This is GDX. So I did this last week. I took all the candles off just because they're worthless, because this is a worthless trading range, really, from 21 to 25. This is a big trading range. I mean, don't get me wrong, that is a 20% swing from the bottom to the top. So I'm really keeping an eye on GDX right here for several reasons. The biggest reason of them all is the GDX versus the GLD ratio. And when this relative ratio is declining, means the miners are underperforming the metal. You want to be in a bullish environment where the miners are outperforming the metal, okay? So learn that from Greg Chanel from Stock Charts. So when the miners break out relative to the metal, which it happened right here, you had a really nice move. Now, this was about a 15% move, and then it just went, continued its trading range, okay? So let's look at the next breakout. I just kind of drew it, and you can draw these wherever you want, I get that. But let's draw it at the next breakout, and you can see that miners broke out relative to GLD, and you had a little uptrend, and then it failed. Well, now you got to break out again, right? You got this little horizontal breakout, and you have the miners to metal breakout right here of this long downtrend. And if this curls up any, that's a pretty decisive breakout. So then we would be waiting on what's going to happen from here. So right now, I would say we've gotten, probably need another couple of days, but we've gotten a signal just like this and just like this. And that's what's happened after it. It never got out of the trading range above 25, but I mean, it's one of those things where it can be in the trading range just long enough to wear you out and get you to forget about it. Then it makes a big multi-year move. So just keep that in mind. I know that we've gotten the last two signals we've got a little tradable rally. This is pretty choppy. Well, just commodities are choppy in general, but now it's happening again. So do we get another tradable rally? I don't know. To me, it really doesn't matter until we really start to look like we're going to get out of a trading range. But gold is something that I'm really looking at right now to see if it can, say it makes a move from 21 to 23, retrace, and if the miners can hold and then just resume, then you might want to look at taking a stab back above 23 to see if it can get out of here. I personally have no problem taking several stabs, cautiously optimistic it will break out of its trading range, but you definitely want to take some profit on the way up. So that's really it today. I think that if I can recap anything from what I hope you've learned today is let's pay attention to the rising 20-day moving averages for the S&P 500 and the Nasdaq and see if they can hold. If they can hold or come down and test it and find a reversal right at it, I think there's an opportunity to put some more money to work. As far as what's strong in the market, energy, commodities are clearly strong. We are towards the back end of the business cycle where typically commodities get strong. So it is something to just really consider and find a way to add, maybe some energy stocks or some energy ETFs or some commodity stocks in your portfolio, or at least up for consideration. Let me know if you have any questions. I hope you have a great week.